subsequent to acquisition date. So we're moving past acquisition to the next year. You're responsible for all textbook material in the chapter. Obviously, I'm going to test on stuff I've taught the most. We're ignoring tax effect in the statements in the chapter. We'll add tax in chapter 6. So, chapter 5 introduces consolidated financial statements subsequent to the date of acquisition. So, besides the balance sheet, now we have to do the consolidated income statement and retained earnings statements, and then, of course, the balance sheet at the end of the year, first and subsequent years. Consolidated cash flow statement is covered in chapter 8, just FYI. It's basically the same as a regular cash flow statement. You take the two and the two consolidated statements, look at the changes, and then put it into cash flow. So we're actually not going to cut. So we're going to use the direct method in class. That's where you just put plus minuses. But Appendix 5B, and I've put some Excel files on Blackboard, goes through the 2 examples using the worksheet approach, so all the entries. And on exams, you can use either. When completing consolidations, make sure you keep in mind, and I can't stress this enough, you guys, because I see it. Students get confused on which books they're doing it on. The parent and the sub have their own separate accounting records, and they're called separate entity financial records. Separate entity financial records. The consolidated statements are only done by the parent. No consolidation, elimination. Just trying to write all the words. Adjustment entries are recorded in the parent's accounting records, so be really careful with that. So when the parent's accounting for its investment in the sub on its books, their little investment T account, parent's books, investment, they can either use the cost or the equity method, okay, in their separate entity financial records. So generally, parents will use the cost. There's only one entry. You debit investment, credit cash, and it's done unless it's impaired. And in terms of the equity method, this is where we start doing more and more equity. So equity method requires entries for dividends and additional adjustments to the acquisition differential at year end. So unless the benefits outweigh the cost of using the equity method, the parent generally uses the cost method. You have to know both methods. So if you read the questions, the problem either say they're using the cost or the equity method. So remember, that's on the parent's books. Oh, and this is IFRS, just so you know. Okay, no matter what method is used by the parents, the consolidation entries on the working paper, the consolidated statements will be the same, but the entries on the working paper are going to be different because you're starting off with a different investment balance. Okay, and actually let's just put that at cost, and then we'll do equity, cost, we take away the dividends, we add the net income. Just to remind you. Now, this is in your text, I just copied it here. The steps for consolidation. Okay, now don't try and, well, you don't have to memorize them, but a lot of questions don't tell you these steps, but these are the kind of things you have to do regardless of the question. So your problems might just say complete the consolidated financial statement. Well, in order to get there, you got to do most of this. Okay? On an exam, it'll tell you. It will ask specifically for specific things on an exam. Usually. So, no matter what, your first thing you have to do is calculate acquisition differential and goodwill at acq date. So, this might say year 5, but we might be doing the consolidated statements for year 9. Okay? So we would still do this at acquisition date, then do the consolidated statements at year 9. Okay, then we need a schedule of changes in acquisition differential. So this is new. Then we'll do a list of basic transactions, which is optional, but it's always nice to have, so you can check it off. Realized, unrealized profit schedule, also called intercompany profits. You can calculate consolidated net income for the year, calculate beginning and ending retained earnings as required. You'll figure out which one it is. Complete the ending balance sheet NCI calculation. Do the consolidation entries. It's basically the same plus new ones. So each chapter we're going to keep adding new consolidation entries and complete the consolidated financial statements. So now we're looking at the income statement, the statement of retained earnings, and the balance. So we've moved on. So with this, we're going with the passage of time instead of just acquisition date. And then we're going to add a little more to it in chapter 6 and then a little more to it in chapter 7. Okay, let's go on to page 2. Then I just want to speak briefly about testing assets for impairment. You covered a lot of this material in 315, but the text gives you a nice overview. So if you want a review, that's a perfect place to see it. Because you've already been tested on it. Excuse me, sorry guys. Detailed impairment testing will not be covered on exams. But you can read the text, study Appendix A, and do problem if you want to refresh your knowledge. Or at the very least, you guys keep it for CPA. Now, you do need to remember that impairment is the recoverable value of the item, what you could get for it. PPE, and that's not personal protective equipment, that's property, plant, and equipment, and intangibles with definite useful lives are amortized yearly and checked for impairment. Intangibles with indefinite lives and PPE ready for use are not amortized yearly but are checked. So, for example, it would say patent life equals 5 years, and this wouldn't give a life. Goodwill is not amortized, and that could change again. It's flipped back and forth a couple times in my career. But it is tested annually for impairment at the CGU level, cost generating unit level, and you learned that in 315 also. But we'll keep very simple. It'll say it's impaired. Only be reversed if the underlying calculation for the recoverable amount has been changed. I'm not going to worry about that too much in this course. Okay, so from here on in, we're going to calculate with the fair FVE, the fair value of equity method. Oh my God, I'm having a breakdown. I don't know if that's what it's called. Anyway, we'll pretend it is. FVE, that's all I know. It's not INA. So we're going to use this method for the rest of the course. And the parent has used the cost method for recording the investment. Now, note that you're not always asked for the statements after the first year of acquisition. I am going to show the example after the first year of acquisition and then the second, and we'll treat it as if we two separate problems. But I want to do that because I have to show you inventory in particular. But you can be asked for 3 years or 5 years after. So just make sure you adjust for that in your calculations. You will always calculate AD and goodwill step 1 at acquisition. That is key. So you read a question and it says, do the consolidated financial statements. First thing you do, always calculate AD at acquisition, even if it's year 10 in. Okay, then you prepare a schedule of changes in acquisition differential, which is step 2. So with the schedule, you can sum up the preceding years in one column, and then have the beginning balances and the change throughout the year, and the ending balance. So I'll show you that on the second example, or on the first example. Okay. So let's go through, maybe pause it and read through this example and go through it, and I'll talk a little bit about it, and then we'll go right into it. Okay, so we're doing an 80% ownership, and I don't know why that's here. On January 1st, year 5, Company P purchased 80% of the outstanding common shares of Company S for $27,200. NCI is measured using the fair value enterprise, that's E, approach, or FVE. So, if not mentioned, assume, whoops, that's not even a word. Assume FV for the rest of the course. On the date, Company S's common shares had a carrying amount of $10,000. Retained earnings balance was $6,000. Inventory of Company S had a fair value that was $2,000 greater than the carrying amount, and so everything else were equal to fair values. Plus, there was a patent with an 8-year life valued at $12,000. Goodwill will be tested yearly for impairment. Both companies have a December 31st year end, and Company P uses the cost method, okay, which is easiest for us to understand, but I will be showing you in